Hi, I'm Ross from Smith 150 Group Property Accountants in Hamilton, and this is just a couple of slides, a little bit of information from our webinar that we had a couple of weeks ago. Why using a property accountant can save you thousands, and we've also got it coming up shortly as well, and we'll put the link at the bottom of this so you can see it. But this is just a real interesting topic, and it's one that comes up time and time again. I do a lot of blogs on a lot of information about why I hate normal companies and the issues with them and things that can get caught out. So this is a couple of slides and one example. And it's all about capital gains. So say you've got 4 rentals and they cost you $2 million. So 4 rentals, $500,000 each. And you've held them for a number of years, maybe 10 years or more, and they've doubled in value. So they're now worth 4 million each. Sorry, 4 million total, 1 million each. And yeah, this is part of my webinar. So we've got some names in there, people. So Fred and Lucy are the ones who own these, and they decide to sell 2 rentals. So basically, they're getting $500,000 capital gain on each, or $1 million combined capital gain. So if we look at that in a slightly different way, it's a quite a common structure. You might have your 4 rentals worth $1 million. It's got a $500,000 loan. The second one's worth $1 million, $500,000 loan. The third one worth $1 million. You're selling it, paying off the $500,000 loan, 500 cash left. The fourth one the same. You've got 500,000 cash left. So this is awesome. We sold these rentals. We celebrate. We've got $1 million. It's awesome. So Fred and Lucy are obviously going, they've probably already just about spent this in their mind. They want to take the $1 million out. They want to go party. They want to travel around the world. Maybe not just at the moment. They want to spend up big. They want to maybe pay off their personal house debt or buy a batch. There's some other things that they want to do with this money. And this happens all the time. It's quite common structure and can be quite a common way that people pay off their personal house long term. But there's a problem. This is the company's capital gain and not the individual. So if this is in a normal company, a standard company, it's not an LTC, not a look-through company, the capital gain is stuck within that company. It's not Fred and Lucy's. So we've got issues. So basically, if they take this money, we would have a $1 million overdrawn current account. They've taken money that's the company's and not theirs, that they're not actually entitled to. Under company rules, a benefit has been provided to shareholders, so the company have to charge interest. We're looking at the FBT, the fringe benefit tax rate of interest that the IRD set. It's at the moment 6.22%. So Fred and Lucy take this $1 million out, which is not theirs. The company has to charge them interest at 6.22%, 62,200 extra income each year. So the company suddenly has a 62,000 extra income. It's then got to pay tax on it. If you're at the 33%, it's around $20,000 of extra tax each year. Yeah, this creates huge problems for us. We've suddenly created a $20,000 tax liability, and it's all because of the structure. Using a normal company and standard companies don't work for most people. They're often got minefields like this and create big problems. So you just need to really think through, if you've got a normal company, look at, yeah, is it right for you? And it's not very often that is actually right for people. And is there a better structure? Because otherwise we're left with basically a nightmare. We can't liquidate the company because it's still got 2 properties. It's a nightmare. Becoming an LTC has lots of catches and things with it. So it might not be easy to become an LTC. That might, end up with other issues from it. So really get some good advice in there. To me, if you've got a normal standard company, worth having a meeting with me, worth going through it and seeing whether it is actually best for you, because in most cases it's not, and in most cases we actually want to change it so that you have another structure. So yeah, have a read in the links below. Maybe sign up for our webinar that we've got coming up in a week or two. Why using a property accountant can save you thousands. And yeah, this is one of the big issues, and in that webinar we'll also go through the other one, personal house becoming a rental, and yeah, lots of issues of that we see every day. So hopefully you've enjoyed that, and thank you very much. And yeah, we'll finish it there. Thank you. Bye.